Hey, Bowtie Nation. Thank you for being here. Joseph Hogue with another live stream Sunday, another Beer Money Sunday. I've actually got my coffee today. Got to get to the gym after this, so taking it easy on the beer. But, wherever you're at in the world, your adult beverage or what have you, glad for being here. Glad you're here. Let me know if you can hear me, if you're where you're coming from. I already see a lot of people here in the chat, a lot of Bowtie citizens there. Gamer Treasures from Kansas. Saw Sunny Day and Sam there in the chat. So thank you for being here again. I love doing these Sunday live streams, just kind of a more informal way. I get to take off the bow tie and just an informal talk with you all out there in the nation. Really great video for you today. First ever, we're going to do a live analysis of some of the most popular stocks, including price targets, outlook, analyst targets. We're going to be doing that for NIO, Tesla, Apple, GameStop, and Amazon. So 5 of some of the most important, some of the most popular stocks anyway out there. I'll cover the research, the fundamental analysis, and again, those analyst price targets and my own price target for those stocks. If you like this kind of weekly live analysis, let me know, and maybe we'll start doing that for our live stream Sundays more often. Try doing some of the stocks and what stocks you want me to cover. So go ahead and let me know in the comments below or in the live chat. That'd be great. Before we get started here, I just want to send invite you personally to sign up for the Daily Bowtie. It's our free market daily newsletter we send out every night, 9 p.m. before the market opens the next day. Gives you time to plan your next trading day and your investments. Really going to cover a lot of the news, the strategies, and the trends that we're following in the stock market. So I've left a link to that in the chat, pinned in the chat. I'll leave one in the video description below. Totally free. Just something I like to do for all you out there in the nation. Just kind of a daily what's up. If you can't catch some of the videos. So I want to get started here, and again, thank you for being here. I see all the some of the OGs, some of the Bowtie Nation OGs, Lifters Jim there from North Carolina, Scotty Juan, thank you for being here. A little bit of housekeeping before we get started, because I really want to get to those 5 stocks, that stock analysis. I know a lot of you have been requesting, especially some of these stocks like Tesla and NIO and Apple, and as well as GameStop. We're going to look at what the market's saying about that, what some other investors are saying, and where a fair price target is for GameStop, because obviously it's been skewed a little bit here pretty lately. And then we're going to be doing the question and answer session after that. So if you have any questions, hold them towards the end there, and I'll be sure to answer those. If you didn't get catch last week's videos, covering a lot of our ARC Big Ideas report, we've done AI, we did fintech, we did space stocks. So make sure you catch those. Last week, I believe we did streaming. So check that one out next week. This week, we've got self-driving stocks coming. So obviously, we're going to be highlighting some of the stocks like Tesla that we'll be talking about today. But I'm actually going to highlight 5 self-driving stocks, ride-hailing stocks. ARK Invest actually thinks this could be something like a $3.8 trillion market, the ride-hailing services with those self-driving cars. So it's going to be totally revolutionize the way you think about owning a car even. I think some of the research that I share in that video, it's actually going to be out tomorrow morning, so be looking for that. But ARK Invest believes that this self-driving technology can lower the cost of cost per mile of a car down to about 25 cents. Right now, driving around in your own car, it costs you about 70 cents a mile. So just think about that. If self-driving technology can lower the cost of ownership of a car down to 25 cents through a lot of those ride-hailing services, then does it make sense to even own a car anymore, except for maybe just those long road trips that you want to take with your family? So it's really going to change the way we think about driving, owning a car, things like that. So check that out. We'll also be covering some penny stock videos this week, Wednesday and Friday. Some penny stocks that pay dividends. I'm going to highlight those, as well as some other penny stocks in that car driving ride-hailing space. So be sure to check those out. Now I want to get to this analysis because again, this has been something I've been planning for a while, wanted to do for a while, and I'm kind of excited to see how it turns out. Again, if you want to do more of these live stock, stock predictions, stock forecasts here in the live chat, go ahead and let me know in the comments below. What I'll be doing, I'll be using Webull for our research, looking at some of the fundamental analysis and the price predictions, the analyst recommendations that they have there on Webull. I'll leave a link to that in the description as well. If you sign up there, you get 2 free shares. It's a great app for investing, especially for trading. I use it for their stock simulator portfolio, where the app gives you $1 million to kind of fake trade into stocks, follow some of your stocks and some of that. And it's a great way to test out your strategies. So again, look for that link. If you sign up, you get 2 free shares. I get an affiliate commission, so I appreciate that. Just a way to support the channel. But let's get started here with Apple. And I'm going to bring up our Apple research here. And these might be a little difficult to see, but I'll walk you through these. Let's close this out. Okay, so right here we have Apple. And with any stock, when you're analyzing a stock and trying to figure out, what its earnings are going to be and where the price, more importantly, where the price is going, right? You have to know, what really drives that stock. Okay, and Apple is a great example of this, and it's really why a lot of analysts, if you follow any of the professional Wall Street analysts, then they'll typically just focus on one stock or a group of stocks, right? You very rarely have an analyst working for some of the bulge bracket banks that cover all the stocks in the stock market, right? They'll cover tech stocks or even chip stocks, even a smaller part of tech or an industry within a sector. And it's because you really do need to know what drives that stock, what drives that company and that industry. And again, Apple is a great example of this, because whenever you're analyzing Apple, whenever you're trying to figure out where Apple is going to go, it's all about the product cycle. Okay. A lot of stocks will follow the economy. A lot of stocks will follow interest rates. Apple follows its product cycle. Okay, so anytime the Apple releases a new iPhone, because iPhones are still predominantly the largest source of revenue for the company, then obviously in the build up to that, even as the rumors come out for that, then the stock is going to do very well. Conversely, when those older models get older, right, and the sales growth from those models start weakening off, then the stock price weakens. And we saw it much more in the past, where it might take Apple a year and a half, 2 years even to release new iterations of the iPhone. Lately, they're trying to do it every year, so that's good and bad for the stock. One, it kind of smooths out that product cycle, so they can ramp into a new phone and get those new sales on those new phones each year. But it also it also cannibalizes a little bit the older phones, right? So when Apple was releasing a new phone series every 2 years, then obviously there was lots of sales for that older phone model, because it was going to be 2 years before the next one. Well, now, if it's 6 months since their last phone model release, then people are looking at, okay, well, you know what? They might release another one this September, so why am I going to buy the older model when I could just wait 6 months? So it kind of cannibalizes some of those older sales. And that's not always a good thing. But let's look at Apple. Let's look at where they're at now. Some of the fundamentals there, and where analysts and myself think it might go. Now now part of that cycle, and something that you really have to follow with Apple, is that we just got news recently that they slashed their supplies. So company recently told suppliers that they did intend to build those 230 million iPhones in 2021, but they did cut orders across the board by about 20%, and mostly it was in that 12 mini model, right? The iPhone 12 mini. It's a little bit cheaper. It's their cheapest model for that 12 series at $699. And the problem with Apple, and this is something that they've had this problem in the past, they'll probably have it in the future because it's kind of unavoidable, is because, everybody says Apple phones, they're so expensive. I want an Apple, but it's $1,000 to get an Apple without some kind of a 2-year plan. So people say they want a cheaper iPhone, right? Well, then they come out with the iPhone mini, something like this, that's a smaller screen, cheaper price point, and people just don't buy it. And the reason why people don't buy it is because they figure, okay, well, you know what? If I'm going to pay $700 still for a phone, then I want the bigger one. So they'll buy maybe an 11 or an iPhone 10 or whatever. They'll buy one of the older models for the same price and get the larger screen. And then they'll just figure, okay, you know what, in a couple more years, then the iPhone 12, the larger series of iPhone 12 will be cheaper then because they'll be older, and I'll buy one of those instead of buying this cheaper, smaller model. So Apple's had a real problem with the demand in the iPhone Mini, and that's really resulted in this cut of about 20% to orders from their suppliers, from a lot of their the fabrication suppliers that go into the iPhone. They do say they like I said, they still plan on building out about 230 million iPhones this year. That'd be about 11% up from last year. And again, like I said, since they've gone to that once a year model, it has smoothed out that product cycle problem that we've seen in the past, right? So right now, and fortunately for Apple and Apple investors this year, is that the Mac and the iPad growth has been very strong from the from the pandemic. People working from home, they need a new laptop, they need a new pad, so they're buying those Macs and iPads. Not certain, how far that can go, but it's certainly helped the stock this year, even with weakness in that. They've grown to 1.5 billion people on that active installed base across their Apple products. So that includes, the watch, the Mac, iPad, the phone, everything. So that's really a huge ecosystem. And that's really where a lot of Apple's strength comes from is, they can release a product and they've got 1.5 billion people to advertise to it to. Okay, so if they come out with, the watch, or eventually if they come out with the car, then they've already got a huge installed active base of users that they can launch that to and really get those products out. The supply and chips shortages doesn't seem to really be affecting the stock lately. Okay, so obviously, especially if you've been following the channel, something we've been talking about is that shortage in semiconductor chips that have really hit a lot of industries. The IoT, Internet of Things, really the automobile industry more specifically, because a lot of the chips that are going into the cars are in short supply. Hasn't really hit Apple quite as much, and partly is I think a lot of the Apple chip suppliers, Qualcomm, Taiwan Semiconductor, a lot of those, they're obviously giving preferential treatment to the orders to Apple because Apple is such an important smartphone chip user that they don't want to piss them off. So haven't heard a whole lot from Apple as far as the chip shortage, the supply shortage that we've been seeing larger. Trade and logistics hasn't really been helping them or been hurting them much either. Could always be a headline risk, but it really doesn't appear to be a factor. Longer term, Apple just started switching to its own ARM-based chips within the phones from Intel, so I think that'll probably drive the margins, drive the profitability a little bit higher, going forward. So that's always a good thing, obviously. Right now, as far as company fundamentals, Apple is paying just a 0.69% yield, which is crazy low considering the company has $77 billion in cash. They usually raise their dividend for the May payout. So, and the last dividend was last May. So I expect another one soon. So, if you're looking at Apple, expect to get a little bit of dividend bump pretty soon here in this next May payment. Shares have obviously done very well this year, and cash flow is great as well. Usually when I'm looking at a stock, when I'm analyzing a stock, I'll go right to the debt. Especially over this last year, a lot of companies have had to issue tens of billions of dollars in debt. Especially in the hardest hit sectors like cruises, airlines. Those you always want to look at that debt load as well as the cash on hand to make sure that they're able to survive any short-term weakness. With Apple, it's really not so much of a problem here because they have so much cash and so much cash flow, right? This company is generating $80 billion in annual free cash flow, right? So again, with Apple, it's kind of a special case among stocks just because they do have such a solid financial position and that huge installed base. It really is just that product cycle. So if you're going to invest in Apple, especially for the short term, and kind of trade in and out as well, then you really need to be aware of that product cycle, where it's going, how fast it's refreshing. Okay, so now they do plan on they do plan on doing that This year, I think in the first half, they're expecting to refresh the iMac and the iPad designs. And then in the fall, which their normal September event, they're expected to release 4 iPhone 13 models and the Watch Series 7. So be watching for those. The stock usually moves a few months before those in anticipation, especially if it's on any kind of a weakness like it has been this year. Apple hasn't been really hit quite as hard as as some of the other tech stocks, the other growth stocks in that interest rate environment. As interest rates increase, a lot of these tech stocks, especially the high growth tech stocks, have been coming down. Hasn't hit Apple quite as bad. You have seen a little bit of weakness there in the stock price, but that's generally because it's already a great cash flow machine. Okay, most of these tech stocks, these growth stocks that you see hit hardest, they've got their cash flows years and years out in the future, even decades for some of them. Okay, you can look at companies like like Teladoc, even Tesla, which we'll talk about later. Some solid cash flows right now, but the vast majority of cash flows for that company are going to be out 5-10 years into the future. So when interest rates increase, then we have to discount those cash flows more to get them down to a present value. With Apple, you really don't get that because they already have the cash flows right now. Not saying that Apple doesn't have some great future cash flows ahead of it, but a lot of their cash flows are right now, so you're not discounting those quite as much with those higher interest rates. So if you're in tech stocks and you're worried about those higher interest rates this year, then I don't think you have to worry too much about it with Apple, especially with that refresh product cycle coming. Here we see the middle chart here, and it might be a little bit hard to see. We're expecting $4.45 per share in earnings expected this year. That's about 35% earnings growth from last year, and but then just about 5% growth for 2022. So obviously very much of a rebound story for that growth this year. Leveling off a little bit, they'll beat that. Apple is masterful at gaming these earnings expectations, right? So they can beat them. Apple always beats earnings expectations just because, Tim Cook and the team over there is so good at making sure that analysts have earnings expectations that are high, but not too high that they can't beat them. This puts it at the shares at 27 times on a price to earnings basis. Okay. And if you really look at Apple over the years, 18 times. If we look back at 2019, then it was trading right around 18 times price to earnings, and we've seen it as low as 10 or 15 times earnings, right around the low points in that product cycle. Okay, so if you look back on Apple and some of the weakness it's had, especially when the product cycle gets a little bit old, when when some of those iPhones get a little bit old, then it can fall to as low as 10 and 15 times on those earnings. So 27 right now is extremely expensive, and especially even if you look back at 2019, like we said, 18 times price to earnings. And what I want to do with some of these, and what we did a couple of weeks ago, is we looked at some of these stocks, where they were trading at on a price to earnings basis right around 2019, when interest rates were a little bit higher. Interest rates were right around 3% then, a little bit more normalized interest rates instead of the, the 1.6% we've got right now. So, and the problem with that, of course, again, is, as interest rates creep up, then you discount those cash flows, those future cash flows a little bit more to find the present value. So Apple or any stock, it's going to be, the price to earnings ratios that you see in the market are going to come down as those interest rates come up. And there's no doubt interest rates are going to come up this year. You can't have 6.5%, 8% economic growth and push, $7 trillion into the economy without having higher interest rates. Okay, so most people are calling for interest rates of at least 2%. I think they'll get beyond that. I think we'll see interest rates of maybe 2.25%, and this is on the 10-year Treasury bond this year. And of course, again, as the market discounts stocks, those future cash flows, by those interest rates, by those higher interest rates, then it just can't support these higher PE ratios. Okay, so what I think you'll see is we'll stay on Apple as an example, 27 times PE now. It might only trade for 25 or 20 times price to earnings here towards the end of the year while those interest rates are higher. It's not saying that Apple isn't still doing really well, but it's just it's just fundamental analysis of the market and of those future cash flows. So again, right now, 27 times price to earnings, 18 times price to earnings around the end of 2019, and 10, 15 times earnings there when that product cycle gets a little bit older. Now, we've already talked about some of the near-term catalysts there with the refresh cycle first half here, the iMac, the iPad designs, and then the new iPhone 13 model coming in the in the fall. So, and then now we'll look at these the analyst expectations, and I'll talk a little bit about my own here. You can see obviously analysts really liking Apple here, more buy recommendations than hold or sell or anything like that. Looks like only 17% of analysts have a hold recommendation. About 4% have underperform or sell, and the rest are all strong buy and buy. Analysts trading right now at about $120 a share. Analysts see Apple over the next year at about $152 on average, which would be about 34 times that 2021 earnings. So, and the ranges here are from $83 to about $175 per share. Now, that's tough. I mean, I do believe I'm 99% confident that Apple will beat that $4.45 per share, earnings per share that analysts think they'll report over 2021. But even at like 5 times. So let's say this. Let's do the average analyst price target 152 divided by, let's say they can do $5 a share in earnings. That's still 30 times on a price to earnings basis. And again, like I said, whether they can release some better news, stronger product cycle and whatnot, whether they can do that or not, they're still going to be fighting this this upward pressure, this downward pressure, this headwind from the higher interest rates. Okay, you look at all stocks, right? All stocks in 2019, and then they pretty much just went exponential in 2020 when those interest rates went down to zero. Okay, so just on a fundamental economic sense, when those interest rates come back up, then that price to earnings for the market itself, for the market in general, for all stocks is going to come down. And it's going to be very hard for Apple to support a price to earnings of 30 times on a price to earnings basis. My own estimates, I'm estimating for about that $4.90 per share in earnings for this year. A little bit higher next year. I'm giving the shares a range of about $90 to $125 on 18 to 25 times on that PE basis. And again, a lot of that is that downward pressure from interest rates. I mean, I think even if Apple does everything right, the higher interest rates, it's gonna make it hard for Apple to trade for anything more than 20 to 25 times on a PE basis. Okay, and so I think if you're investing in Apple, obviously Apple can be a great long-term investment for you. It's cash flows out in the future. It's going to have the Apple Car. It's going to have the iWorld, where it's just going to control pretty much the whole world. So the cash flows are there, the returns are there. But if you are looking for shorter term trades in Apple, if you are looking for a good entry point in Apple, I think you can get it here over the next year. 120 is not a bad price, but I think there's the upside is limited on that PE basis. So look for it around 120, 110, maybe even $100 a share. I think you can get in there over the next year at that. So now I want to switch focus here. And I want to cover GameStop real quick. And again, so in this we're covering GameStop, we're covering Apple, we're covering Tesla, NIO, and Amazon. Some of the most popular stocks out there. Wanted to kind of do this first one, and I see a lot of people asking for NIO now or NIO last. I've already got the order set up, so that's just how it is. If you're watching in the replay, I'll try to put timestamps in this, but since it's a live, it's hard to put timestamps in the video for when I'm going to cover something. Now, okay, so for GameStop, reported its 12th consecutive quarter of slowing sales, and management wouldn't take questions on that earnings call last week, right? Which is obviously never a good sign when management doesn't want to take any questions from analysts, from investors. And really let the market know where they're going with that. So, and that share is plunging down about 50%. It's rebounded since then on that social media strength, And for GameStop, that's really what you got to understand here is the fundamentals just do not support this kind of a market cap, this kind of a size for this company, but it still does have that social media strength. Okay, this is the poster child for that Reddit social media investor phenomenon, and there are opportunities in the stock. But you're going to do much less fundamental analysis here. Again, like what we talked about, you really have to know what drives the stock. And for GameStop, it is very much that cycle of investor enthusiasm and that. The bulls right now are hoping that an activist investor and board member, Ryan Cohen, can force a shakeup and really take sales from that video game software and a hardware idea into. Well, I mean, that's kind of the problem. They really don't know yet, right? They want to move in more into the digital space, kind of like what Electronic Arts has, what some of these more digital video game retailers have, but they really don't have a good plan for that. And of course, that's why management wouldn't take those questions during the earnings call, because they really don't have that figured out quite as much. Basically, they need to be making in that digital space. They need to be doing something that's going to drive sales to support the shares at this price. Okay, because right now, you can see this middle chart here. Sales just aren't there. Revenue isn't there. I've got the sales here expected for this year. Fiscal 2021 came in at negative $2.14 a share. Next year expected better, but still negative 78 cents a share. And this is a company that doesn't have the cash flow and the the cash reserves to wait it out. That's very much a funding story right now. Revenue is expected to fall to about $5 billion next year from $6 billion in this fiscal reported year. So they've got the problem with GameStop is they need, if they're going to progress beyond this social media investor phenomenon to a legitimate investment, they need to move and drive sales that are going to support the shares at this price, or just let the shares drop and start over, basically. If you want to look at an example, Electronic Arts in that digital gaming space, and probably a good comparison to where GameStop needs to go, where they want to go, shares are trading for 6.6 times on a sales price to sales basis, right? So if the current GME, the current GameStop market cap is about 13.2 billion, it would, on that price to sales basis, it would need to produce 2 billion in annual sales in really a totally new vertical. I mean, right now they're doing that with their traditional retail sales model, the in-store sales. But if you look at the revenue here in this middle chart, I mean, it's fallen from 8.5 billion down to 8, down to 6, expected down to 5 this year. So obviously, very much revenue weakness there. They need to transition the company into a digital sales company and have that 2 billion in annual sales to be able to support that. So near and long-term catalysts, let's look at that for GameStop. I fully expect them to sell shares and capitalize on that share price. They haven't reported it yet, but they actually did file with the SEC, the Securities and Exchange Commission, in that quarterly report that they're evaluating selling shares on the open market. They didn't mention it in the call. Obviously, they didn't want to spook investors and spook the market. That announcement, like we've seen with a lot of these other companies, we've seen it with Amazon, or not with Amazon. We've seen it with American Airlines. We've seen it with Carnival and a lot of the cruise lines that have taken advantage of that big run up in the share price to sell more shares. Get the funding that they need to survive, basically, and take advantage of those higher share prices. And what's it done? It has tanked the shares, right? You see generally 10-20% loss in the share price when they come out with these new share offers. I think it'll be much higher in GameStop. But I think it could be an opportunity for a rebound and an eventual turnaround to grow into that digital space. So if you are investing in a GameStop, be watching for that. Be watching for that announcement that they're going to issue those shares. They have just $450 million in balance sheet cash, so they definitely need the funding if they're going to make any kind of strategic acquisitions to really be able to evolve this company into the digital space. So again, shares trading at about $200 for GameStop right now. I think it comes down from there when they make that share announcement. But if they can keep that social media investor phenomenon, then that can come up. Look at the analyst ratings here. Obviously not pretty, because and one thing you got to understand with the analyst expectation, analyst price targets on a lot of these stocks, especially these meme stocks, right? These Reddit-driven social media phenomenon stocks like GameStop, like Sundial. Analysts can't price those on sentiment. They just don't have in their models, right? Analysts are using those cash flow models to price a stock, to price the present value. And then just on those fundamentals, on those cash flow models, it's a screaming sell. Okay, you look here and there are no buy ratings, no strong buy ratings. Even the courageous analysts, we'll call them, about half of them, about 47% of the analysts have a hold on the shares, which basically says they don't want to get involved, right? They're not telling you to buy, they're not telling you to sell, they don't want to have any part of this. You've got about 42% with an underperform, 14% with a sell rating on the stock. And again, it's all based on those fundamentals, right? The fundamental business model of the company. None of that sentiment, which right now is everything for the stock. They've got analysts have price targets for GameStop at average of $40 a share. One analyst actually has a price target of $175 a share, which is still below the current $191 price right there. I think if you're going to be investing in GameStop, you need a trading strategy. Okay, this is all about investor sentiment and really that cycle of social media enthusiasm for the stock and for that group of meme stocks. So I think you can wait for the big drops to start and position and support right around $150 a share, right? We've seen over this past couple of months where there is support at the very bottom at 50 and then at $100 per share. So I think you can take advantage if it gets back down to those levels. Maybe even 150 at this point. I don't know that I would be buying in quite so much there at 150. If it falls down to that point, I think I would wait a little bit longer. But then selling on those strong up days, right? Selling on those days of around 150 and 200, because that's really where the resistance is on the stock. Again, if you're going to be investing in GameStop, you have to have a strategy like this, and you can't be afraid to take your profits, right? You don't have to sell at the very peak. I know a lot of people that maybe get lucky and they get in at 100 or they got in at 50, and they see it rise to 150 to 200, but they don't want to sell because maybe it goes back up to 400, maybe it goes even higher. They don't want to sell that lottery ticket, but okay, you know what? It's going to be very difficult for it to go up that much higher. You don't have to be afraid to take your profits, right? You don't have to sell at that very peak. If you're doubling your money in a month, that is the best any investor can ever expect to do. So I think in something like this, I think you wait for the price to come down to that key support, $50, $100 per share. Get your profits out at 150 and 200, and then wait for the next round. Wait for it to come back down on those. Again, I think I would be waiting right here. I would be waiting for it to come down, and especially come down around the share price issue, right? Wait for them to announce that they're gonna sell those shares. Okay, let's do everyone's darling, Amazon, and bring up our screenshots here. So Amazon, obviously a big beneficiary of the lockdown, of that shift in e-commerce. And really that's just watching some of the price targets for GameStop here, and obviously the GameStop bulls have it to $1,000 and above, $300. I don't think it gets there. Maybe it does. Maybe I'm wrong. But you have to have a huge rush of investor sentiment to get it back up there, especially given that weight of the coming share price sell. They've evaluated it. They need that money to be able to survive and evolve into the digital vertical, and they're going to make that announcement. So I'd be waiting for that. Anyway, Amazon. The thing you really got to watch about Amazon, e-commerce has been their biggest revenue driver. Obviously, e-commerce sales grew 40% last year. It really packed in about 5 years of growth all in one, and right now it's around 21% of total retail sales. Okay, so obviously a very long-term trend, and Amazon is one of the best stocks to be in that. What you get with Amazon, though, and this is something that I like about Amazon, I like about Salesforce.com, I like about Google, is you're really getting some of these companies that have some very big, we call them lottery ticket bets that aren't priced into the shares. Okay, with Google, you get Waymo, you get a lot of those, the self-driving stuff that really isn't priced into the shares. With Amazon, I think the current stock price is really built and based on obviously their e-commerce, which is the majority of their sales, the cloud, which cloud. AWS, Amazon Web Services, is now the largest service in the world, the largest cloud service in the world. It's a multi-decade trend, so I think that's that's built into the shares right now. But you're really not getting a lot of the AI, the artificial intelligence, the drone delivery, a lot of those longer-term lottery ticket plays that you might get here, in the next 5 or 10 years. So it's really why I like a lot of these large conglomerate, mega tech stocks, is because they do have a very strong business as the base, and that's what the shares are priced on. But they also have those moonshot investments, what a lot of them calls them, that will take the shares on higher. And again, e-commerce, Amazon has that. They have the cloud. What I really like though is that AI, the artificial intelligence theme, and as well as drone delivery. I mean, do you realize how much Amazon could cut in costs from just being able to deliver half their packages, or just that last mile package delivery through drones? And it's closer than you might think. I think we will get drone delivery, mass scale drone delivery here within the next 2 or 3 years. By 2025, we're actually going to be doing a video on that, some of the best stocks in drone delivery on the channel. So be watching for that. That's in our ARK Invest Big Ideas report. Those 15 life-changing ideas, those big 15 life-changing trends that we're looking at over the next 10 years, and covering the best stocks to be in on that. As far as company fundamentals, this is kind of a lot like Apple. I mean, Amazon has such solid cash flow and cash reserves and all of that debt, cash on hand, it really doesn't matter quite as much when you're analyzing, compared to when you're analyzing maybe a smaller company. Okay, because Amazon is never going to be out of cash, out of a cash pile to make all the acquisitions it needs. In fact, it has $84 billion in cash and a record $30 billion jump from the last year. Okay, imagine that. Amazon built its cash reserves, its cash balance sheet cash, just sitting there, by $30 billion last year to $84 billion, and it's producing $26 billion in free cash flow annually, right? So what I see as the biggest surprise for Amazon actually here in the next year is either a dividend or a share repurchase plan, right? They've always just kind of focused on growth and just paid for, used their cash for acquisitions and debt pay down, but it just can't spend all this cash. And I think it's a major problem for Amazon right now is, deploying all that cash to where it earns a return rather than just sitting there, rather than just having that $84 billion in balance sheet cash just sitting there. They've got plenty that they can make acquisitions and development and all that. But they've got too much. They've got more than that. So they either need to reinstate the share repurchase program, which I think it's been something like 33 quarters since they've bought back any shares of stock. So obviously not tied to the pandemic. They just don't want to spend their money on anything other than acquisitions and development. But they're going to need to. They're either going to need to institute a dividend or reinstitute that share repurchase program. And I think obviously that's going to be some big news, especially if they start a dividend, because that'll put them on a lot of dividend lists. It'll put them in a lot of funds that only invest in dividend stocks and things like that. Right now, they're expected to report earnings of about 14% earnings growth to $47.73 per share. We see that in this last chart here, this earnings forecast there from Webull. So you see 47.73 expected this year. They always beat their expectations. Again, just like Amazon, that would be a 14% earnings boost from last year. Earnings are expected to jump 38% next year to $66, though there's probably going to be revisions on that. I'm expecting closer to about 55 to 60 this year on a beat, and then maybe 20% next year. So still solid earnings growth for Amazon. That would put shares at 52 times earnings for this year, which surprisingly isn't as high as it sounds given the share's history. Okay, it traded at, again, we'll go back to 2019 for the normalized price to earnings basis, and that actually traded at 78 times earnings. They're in late 2019 before this massive earnings boost from last year, before the interest rates came down. So obviously something like Amazon, where they've been very good at deploying that cash for acquisitions, for development, you got to look at it in a little bit different lens as far as price to earnings basis. You look at it that price to earnings to growth basis. Okay, so 52 times earnings actually isn't quite as high as it might seem. As far as near and long-term catalysts for the stock, core retail e-commerce business is still a long way. It's a long way to go. It's only 21% of total retail sales right now. So even though I think e-commerce growth is going to slow a little bit this year from what we saw last year, as people get out of their house and want to spend more money traditionally in that traditional retail, it's still, e-commerce still only a fifth of all retail sales. So obviously it is, it's going to grow. It's going to grow from there, and that's going to primarily benefit Amazon. Okay, Amazon, Google, and Facebook really are the e-commerce kings. Saw a piece in the Wall Street Journal just last week, I think, that now they're talking about it's really a triopoly between those three as far as e-commerce and online digital advertising, digital sales. I think they own something like 57% of the total market, for those verticals. The one downside to Amazon that you might want to look for, I do see rising labor costs here in the next few years. Just as those unionization pressures build, we're already seeing it here in the U.S. and Europe, where a lot of their Amazon factories, their warehouses are unionizing or threats of unionizing. And obviously with the new administration, I think here in the Labor Department, they just put in a big union supporter as the head of the Labor Department. So, obviously be watching for those higher labor costs at Amazon and what that does. Again, I think over the next 2 or 3 years or longer, you get those drone deliveries, which help to mitigate some of those higher labor costs within the warehouses and that kind of thing. Amazon Web Services still posting amazing 28% growth and becoming a big chunk of the total revenue. Again, it's the largest cloud service service in the world, and really it's a major shift. Intel or Amazon really drove a major shift last year with its own Graviton ARM CPU away from purchasing chips from Intel and AMD. So I think that's something to watch for. Here in the next year, how that affects costs and profitability. As far as analyst expectations, here this middle chart here, so you can see just kind of like Apple, actually, even a little bit more optimistic than Apple. We've got 39% analysts with a strong buy, 56% with a buy, and really negligible. 4% of analysts with a hold, 0 sells, 0 underperform ratings. Analysts have a average price target of $4,000, $3,999.36, which is actually pretty strong. It's about 30% higher from the current share price, around $3,000. Even the lowest analyst price target here is for $3,048, be right around where it's trading now, and you got the high analyst here at $5,200 over the next year. Now the problem with this is that would mean shares are trading at about 80 times earnings. Okay, if we get $4,000 share price on Amazon, the expectations for right around $50 per share, that's about 80 times earnings. And again, given Amazon's history, it's not a surprise that it would trade that high, and I wouldn't think that it can't trade that high. But it's still, they're still going to be facing that headwind from the higher interest rates. Shares have been pretty well flat since mid-year, but haven't really been hit hard as some of those other growth stocks. And like Apple, it's because Amazon has their cash flows right now. Again, they've got some of those great moonshot investments that I think will really boost cash flow in the future. And obviously, cash flow is going to be very strong here for a long time. But its cash flows right now is really a lot of what the market is valuing the stock on. So that means that as interest rates rise, it doesn't affect that present value of those discounted cash flows into the future. I'm not quite as bullish as the average analyst, though, on the shares. I do think they can hit $3,700 this year, and longer term, I think it's a stock that can produce those that consistent growth. Okay, so much more than my short-term, maybe short-term bearishness, I'd say. I mean, $3,700 on a $3,000 stock. It's still a solid. I think that's about 14% upside for this year. Still a very strong return for stocks, but over the long term, I think, like I said, this is one of those, like Google, like some of those other stocks, primarily Google and Amazon here, where you're getting that base e-commerce, you're getting the base cloud services valuation on the stock, and a lottery ticket ride for the future. You're getting whatever drone delivery brings, whatever the AI brings, whatever a lot of these other moonshot investments that the company has. You're getting that just as an add-on, as a freebie. So I think Amazon is probably a good one here on that. Okay, everyone's favorite. Let's look at Tesla. We'll look at Tesla and we'll look at NIO next. And I think obviously. Show that. Okay. Whenever you're talking about Tesla, you got to talk about NIO because obviously they're very much in that same theme. One of the things with Tesla is I'm still expecting a production slowdown announcement. We've gotten it from all the major car manufacturers, Ford, GM, Nissan. A lot of them have said because of the shortage in chips that are now going into cars, going into those entertainment systems, going into everything, right? They're having to slow down the production this year because of that chip shortage. We got it from NIO last week. We still haven't heard anything from Tesla. And I think maybe it's a little bit of hubris. I think maybe it's a little bit of ego. They don't want to make that announcement. But yeah, I think it's inevitable that we're probably going to hear something from Tesla over these next couple of months about some kind of a production slowdown, or at least just see it in the numbers. I still think Tesla can hit 850,000 cars produced this year, which would be a great 70% increase. It wouldn't quite be the number that we got last year. They hit 500,000 shares or cars produced last year. It was a huge increase from the year before. I do think that slows this year because of that chip shortage and that, but it's still a very strong one there. With Tesla, though, it's really about two stories here, and this is something you gotta remember when you're investing in Tesla. This is it's really about self-drive ride-hailing, the services, and that electronic vehicles. Okay, so everybody's focused on EV right now, and really that's what Tesla has been about in the past. But I think the future growth for this company is really in those ride-hailing services, especially the near-term 3 to 5 years. ARK Invest is actually estimating 82% annualized growth in EV sales over the next 3 years, from 2.2 million sold last year to about 40 million cars through 2025. So though the thing is, when you're thinking about that, I think a lot of that's going to have to go to the legacy makers. I mean, if you just look at Tesla's production volume, okay, even if it can hit 1 million cars produced this year, by 2025, it can't ramp production up to 10 million cars or 15 million cars. Okay, so if you do believe ARK's thesis here that we're going to have 40 million EV cars sold by 2025, then a lot of that has to go to Ford, GM, Volkswagen, a lot of these other legacy makers. So there's really a couple ways to think about that if you're looking at this EV theme. I mean, one, Tesla is the undeniable leader, and we'll get to why I think the shares can still be a very good deal, on that ride-hailing theme. But if you're just looking at it from the EV space, if a lot of these other car companies, these legacy car companies that are trading at a fraction of the cost, really a fraction of the price to sales and the price to earnings, valuation as Tesla, as NIO, as some of these startups, then people are going to start buying these cars, these EV cars from these legacy automakers, and they're going to start seeing that they're great models, they're great cars. So if you do believe EV is going to ramp up to 40 million cars here in the next 3 years, as ARK does, I think you got to be in some of these other ones as well. I'm in GM. I was in Ford up to, I think, like $12 a share, and then I cut my position a little bit, but I think they'll still do very well as well. Volkswagen will do very well in EV. But again, Tesla is the undeniable leader, and they're going to benefit from this growth. Now, personally, I don't think we get to 82%. Compound annual growth rate in EV cars, but through the next 3-4 years, right, to 2025. I think it's a very tough sell to say that we get to 40 million cars sold, in 2025. But that's the that's what ARC is estimating. Bigger though than that, I think if you're investing in Tesla, you're really investing in that self-driving ride-hailing theme. Okay, and this is again, this is something that we've covered on the channel. We're going to cover it this week with some of the car stocks that we'll look at. ARC estimates that Tesla, because it's using a camera-based model for its self-driving cars, can launch faster, can launch a nationwide ride-hailing service within the next year even. And that's going to be huge. Okay, so for ride-hailing, for those self-driving cars, you really got to understand there's really three models it's being built on, three strategies, right? Tesla is using a camera-based strategy, which means, all it has to do is produce the cameras and that software for that. And then the cameras guide that self-driving system. A lot of the other makers, they're using the LiDAR system, right? Which is very much more more intensive, software intensive, and that kind of thing. And we'll talk about that in that car stocks and that self-driving video coming. I think that's on Wednesday of this week that we'll talk about that. It's more accurate than Tesla's camera-based system. But if Tesla is able to launch faster, then ARC estimates that Tesla could drive maybe 20% ride-hailing adoption by 2025 if it launches this next year. And again, if you just look at the potential market size for that ride-hailing, again, like we talked about earlier, ride-hailing has the potential, that self-driving ride-hailing has the potential lower cost per mile for transportation down to 25 cents a mile, down from 70 cents, which is where you're at right now with owning your own car. Cars are in your driveway or parked for 95% of the time, right? You really only need your car for a fraction of the time that you own it, right? That 5% of your day where you're driving to work, you're driving out to eat, you're driving wherever, that's like 5, maybe 10% really at the most, unless you're a professional driver, a taxi driver or truck driver or anything like that, right? So what we're seeing here is that as soon as cars become, that level 5 self-driving and have that ride-hailing service, then basically you get 10% of the population, 10% of car owners that say, okay, you know what, I'm going to let my car drive around by itself, pick people up and drive them to where they want to be in that self-driving ride-hailing service. While I'm not using it, while I'm at work, while I'm at home at night or whatever, my car is driving around making me money. Okay. And what that means is you've got millions of these self-driving cars driving around, picking people up within 5 minutes of wherever you're at, a third of the cost as it is to own your own car. So it's really going to change the way people think about owning their own car, about transportation. You may need a car for those long weekend trips that you want to take. Other than that, you're not even going to have a car. You're just going to be using someone else's self-driving ride-hailing car. And on that, ARC estimates by 2025 could be $190 billion market opportunity for the platforms, for the ride-hailing platforms. Another $40 billion for auto manufacturers, $5 billion for the fleet owners. And that's just going to ramp up to $1.2 trillion for the platforms by 2030. So what we're really going to see is just a shift in how we think about car ownership and transportation here in the next 3 and 7 years. And again, ARC believes that Tesla could be the first to really drive that change because of its camera-based technology. So we'll go back to the screenshots here for Tesla. You see it's trading for about $615, down from about $900 earlier. So Tesla is very much caught in that, in that interest rate story. Again, since its cash flows are predominantly further out in the future, it's getting hit harder as interest rates rise, and as you discount those cash flows, those future cash flows back into a present value. So that's why Tesla is just getting harder hit than some of the other stocks we've seen, like Apple, like Amazon, where they have their cash flows right now. Earnings, despite that, earnings are expected up 83% this year. So you see here this middle graph, earnings expected up $4.11 a share this year from $2.24 last year. Revenue expected up to $31 billion from $24 billion last year. So very strong growth still, and a longer term growth story for the future. Now that does put the shares at 149 times on a price to earnings basis and 20 times sales. So by comparison, if we look back to 2019, like we've been doing at that kind of more normalized PE basis, it was trading at 5 times sales in late 2019. Okay, so 20 times sales right now, where Tesla shares are priced at, 5 times price to sales in 2019. Now, obviously, Tesla has really proven its production model, proven its profitability. Back in 2019, I don't think it wasn't even profitable yet. It had those sales, but not the profitability. So it's really proven the model. So I do think, obviously, it's worth more than that 5 times sales. It's worth 10, maybe even 15 times sales. But certainly, it's a harder case to make to have the shares at 20 times on a price to sales basis. Okay, and again, just like we saw with Apple, great company, great cash flows, and very much supportive of that higher valuation when you compare it against some of the other cars. Obviously, the legacy car makers like GM and like Ford, very much more valuable than those companies on a price to sales basis. But as those interest rates rise, it becomes a headwind, and it becomes very difficult for any stock to to maintain those same price to earnings and price to sales ratios that we've seen over this last year. Okay, you have to consider that. You have to consider that we're going into a different interest rate era of higher interest rates, 2%, 3% interest rates, and how that affects those price to earnings ratios and price to earnings sales, or price to sales ratios that the market is willing to pay. Okay. As far as near-term catalysts for the stock, the company did release in February 2020 that it's going to launch that ride-hailing app before it reaches fully autonomous cars. So, I do think they can get that level 5 autonomous car driving here in the next few years. But really, they're saying they're going to start that ride-hailing service earlier than that, just to give them some more experience in that business model before shifting to the fully AV service. Okay, and again, I think they could easily do that within the next year. The Model X, a little bit longer term, the Model X and the Model Y, the Model X is going to be available in late spring with the Cybertruck and the new Roadster expected out early next year. So obviously, I think you're going to get some headline support from those as they, as Elon starts tweeting about all those new cars and trucks coming out. You maybe get some headline support on the shares right there. As far as analyst ratings and my own price target, here this third graphic here. Not quite as bullish on the shares of Tesla from the analyst community. You got about 20% have a strong buy, another 13% have a buy rating on the shares. But you've got about 39% of analysts have a hold rating on the shares, and even some of the analysts that don't mind speaking out against a stock that always seems to go up. You got about 17% underperform, about 11% sell ratings on the shares. And in fact, the average analyst price target on the shares is just $621, right? Which is only, $5 above where it's trading at now. So basically negligible return on the average analyst price target. You do have price estimates all the way from $67 on the low end. I don't know who's that, why they still have a job, but you also have, as high as $1,200 on the high end. And in fact, ARK Invest is estimating a $3,000 price target, largely based on that ride-hailing service. Okay, obviously Amazon's EV, the electric vehicles, is really where the company is at right now and priced into the stock. I think what ARK is looking at is, over the next year, if they can launch that ride-hailing service, then that would justify maybe a $3,000 price target. Not quite there myself on the shares. I think that's that's a little high to invest. You really have to believe in that near-term ride-hailing catalyst. Okay, for the electric vehicles, it's there. It's it's definitely supportive of the share price and of those sales growth. But even on 10 times next year's sales, which again, right now trading at 20 times sales, Tesla's shares are trading at 20 times on a price to sales basis. It was down as low as 5 times price to sales in 2019. Even on 10 times next year's sales is only a $400 share price. And so we have to see significant surprise growth to really support the shares at this level, I think. It's been down 30% from the January peak and likely to be pressured all year from those higher interest rates. So I mean, I know this is going to piss off a lot of you Tesla bulls, a lot of the people that believe in the story, and that's fine. It's a long-term investment for you, and I think it can be a great long-term investment on that ride-hailing system and the future of self-driving. But I would be more comfortable at a $500 per share price target. That might not be the floor even. If we see interest rates jump up again, that might not be a floor to the price, but I would be more comfortable at $500 a share. And honestly, that's realistically, that's only 14% down low now. I mean, it's down 30% from the January peak. I think it can go down another 15%, and that would be at a point, or I think I would be more comfortable buying shares, getting in on that longer term story. If you do want to, if you can't wait, if you want to buy now, I think you buy, maybe a third of your money right there. As it is now, 615, it might come down in the near term, but if you're holding it for long term, it shouldn't matter quite as much. But I think you do hold some of your money aside to invest at maybe a lower price over the next year. If you invest maybe 30 to 50% of your money that you want to invest, say you want to invest $100 in Tesla right now, theoretically, because unless you're on a platform that does fractional shares, and you can invest $100. But say you want to invest $100, and so I say instead of investing the whole $100, you invest $35, maybe $50. You buy a fractional share, right? And then you wait for that price to come down. If the price keeps going up, you've got the fractional shares anyway. You're gonna benefit from that share price keep on going up, and that's fine. If it does come down, though, I think you're gonna get a much better price here over the next year. Okay, one more stock here. We'll cover NIO, and then we'll open it up to your questions. And with NIO, you really gotta think about that. That Tesla story, that EV story, right? Now, NIO doesn't necessarily have the ride-hailing upside as Tesla. It does have a partner with the Dida app there in China, but it doesn't have its own, ride-hailing platform, the app, all that upside that I think Tesla has in its own ride-hailing, self-driving ride-hailing service, right? It launched its own autonomous vehicle model, the ET7, in January. So there is some potential in that field, in that vertical, but it's just not as directly related to EV or to NIO as it is to Tesla. It does have strength in that EV and the autonomous vehicle vertical, especially in China. But really, my thinking for NIO is that if you believe in those two verticals, the electronic or the electric vehicles, the autonomous vehicles, if you believe in those two stories, then why not? You really need to be in Tesla instead, because Tesla has that plus some of the other levers that it can pull for growth. Tesla has that ride-hailing service it can pull for growth as well. Tesla has some of the other things that it's doing. So I mean, we'll go over the fundamentals and the valuation for NIO, but if you're in NIO, then you got to question, okay, why am I not in Tesla as well? Sales are expected to double to $2.5 billion this year, and then nearly double again next year. You see here in this middle graph here, you can see the earnings, still negative earnings, expected to post negative 12 cents a share here in this first quarter of 2021. But if you look down further down here in the revenue side, I mean, it's really a revenue growth story. Even on the recent drop, though, shares are priced at 22 times sales and with negative earnings, so you really can't get a price to earnings basis. But that's actually a little bit lower. It was trading at 35 times sales at the peak. The peak in January there, it was trading at 35 times on a price to sales basis. Now only 22 times. So I don't know. Maybe if you're a NIO bull, then you can look to that as some optimism, I guess. It traded for just 6 times sales mid-year of last year. So definitely a discount, to Tesla, and really just kind of a new story in NIO this year. So I do think if you're looking at NIO, you got to question, okay, as the interest rates go up, does it support that 22 times on a price to sales basis, even higher than Tesla is right now with that 20 times price to sales basis? Again, it's 43% down from the January high and still relatively expensive. So I think those rising rates are likely to weigh on the shares all year, even if we do see that sales growth that jumps, that doubles from last year. It did announce that production suspension in China to start March 29th and run for 5 days because of the chip shortage. So it now expects to deliver just 19,500 vehicles in the first quarter versus a prior expectation of around 20,500 vehicles it had said before. So still, very much a growth play. 20,000 vehicles delivered per quarter versus something like 850,000 for a year on Tesla. Looking at analyst expectations here, or analyst price targets in this third graph here, analysts are optimistic. You basically just as optimistic as they are with Tesla there, maybe even more so. 20% of the analysts have a buy rating on it, or a strong buy. 40% have a buy rating. So I guess coming down from the highs in January. 30% have a hold rating, and then 10% have an underperform rating but no sells. So still very much optimistic. They've got an average target of $56 per share on the $57 a share over the next year, which is over the $35 where it's trading at now. So about $20. So about 60%. About a 60% return potential on this average analyst price target, but it does range from about $13 a share up to $90 a share for analyst expectations. Now, again, though, from my own point of view, I would have a hard time valuing NIO at a higher sales multiple than Tesla. Okay, right now, like we said, it's trading at, even after that big drop, even after that 43% drop from the peak, NIO is still trading at 22 times its price to sales basis. Okay, versus Tesla, which is only at 20 times. The U.S. company just has more growth drivers and longer term potential. I do like NIO for its domestic growth there in China, and I think they can do very well there. I do think you get a problem with, especially in the near term, when you're looking at NIO and you're looking at these China-U.S. relations. I think if NIO tries to launch massive nationwide in the U.S., I think they're going to get a little bit of pushback from the administration as far as privacy concerns. What kind of information are the cars collecting? To drive that self-driving, that auto ride sharing, or that auto driving feature. And in China too, it could hit Tesla. The Chinese government has recently come out and kind of blacklisted a few U.S. companies on that privacy information collecting concern. That's really the main weapon being used back and forth between the two countries right now. And I think we see that in Tesla and NIO. Sometime in the future, China automakers are going to start saying, well, I mean, they've already said that I think the government and military members can't drive Teslas, right? Because they don't want that personal information collected on them. And I think, if that competition heats up between NIO and Tesla, and we don't see some kind of a thawing in the relations between the U.S. and China, I think we do see that heighten, that risk to each of these two companies heighten in the other countries. So I think that's something to watch for. I would put NIO closer to maybe 10 times a sales target, which would justify right around a $50 stock price on next year's sales. So actually maybe a little bit higher than right now. It's a growth company. I do like I said, I do like the domestic exposure it has there to China. 10 times next year's sales would put it at $50 strike price, but not quite there yet this year. I think on $2.5 billion sales this year, that only puts it at about a $25 strike price, or $25 stock price right now. So if you're going to use that longer term growth perspective, then yeah, maybe buy into it now. If you're just valuing it on this year's sales, then maybe a little bit expensive right now. So that's our stock analysis. We did Tesla, we did Amazon, Apple, NIO, and GameStop. If you want to see me do more of these live stock analysis, let me know in the comments. I want to push it over to the questions now.